What if you could turn your monthly coffee budget into $1 million portfolio? It sounds like a fantasy, right? Especially when you're starting with just $200 a month. That's less than $7 a day. Most financial gurus make it seem like you need a six-figure income, a secret stock tip, or a huge inheritance to even dream of hitting that seven-figure mark. But what if they're wrong? What if the real secret isn't about how much you earn, but about how consistently you invest? The truth is, the path to your first million is paved with small, repeatable actions, not giant leaps of faith. But which path actually gets you there? Is it the high-speed lane of the stock market? The safer route with bonds? Or is it the tangible world of real estate that everyone talks about? In this video, we're putting 4 of the most popular investment strategies to the test. We're not just talking theory, we are going to simulate the entire journey. We'll crunch the numbers and show you exactly how long it would take for each method to turn that simple $200 a month into a cool $1 million. The results will surprise you, and one of these paths is definitely not what you expect. By the end of this video, you won't just have an answer. You'll have a clear, actionable blueprint to start your own journey today. The foundation. Understanding the $1 million engine. Before we dive into our 4 paths, we need to talk about the engine that powers this entire journey. It's a concept you've probably heard of, but its true power is almost impossible to appreciate until you see it in action. I'm talking about compound interest. Think of it like a snowball. You start with a small one at the top of a hill. As you roll it, it picks up more snow, getting bigger. As it gets bigger, it picks up even more snow with each rotation. Before you know it, the snowball is growing on its own, and its size starts to increase exponentially. Your money works the exact same way. Your first $200 is the small snowball. The interest it earns is the first layer of new snow. The next month, you don't just earn interest on your original $200, you earn interest on the interest too. That's the magic. Let's use a quick example. If you start investing $200 a month at age 25, by the time you're 65, you will have personally contributed a total of $96,000. That's a lot of money, no question. But with the power of compounding at a reasonable rate of return, that $96,000 could have grown to over $1 million. That means over $900,000 of your final portfolio would be pure growth. Your money made more money than you did. That is the force we're using today. Every path we're about to explore is just a different vehicle driven by the same powerful engine. The main difference between them is the speed of the vehicle and the turbulence you might feel along the way. The key is to pick a path and stay the course. Now let's get into our first and fastest path. Path number 1, the stock market speedster, index funds. All right. First up is the path that, on paper, gets you to the $1 million mark the fastest. We're talking about investing in the stock market, but not by trying to pick the next big meme stock or tech giant. We're doing it through one of the most reliable and recommended ways for beginners and experts alike, low-cost index funds. So what is an index fund? Don't let the name intimidate you. An index fund is just an investment that holds all the stocks in a specific market index, like the S&P 500. The S&P 500 is simply a list of 500 of the largest, most established companies in the US. So when you buy a share of an S&P 500 index fund, you're not betting on a single company. You're buying a tiny piece of Apple, Microsoft, Amazon, and hundreds of other powerhouse businesses all at once. It's the ultimate form of diversification, protecting you from the dramatic failure of any one company. Now let's talk numbers. The historical average annual return of the S&P 500, including dividends, has been around 10% over the long run. After factoring in inflation, the real return is closer to 6% or 7%. But for our simulation, let's be a little conservative and use an 8% average annual return. The simulation. Monthly investment, $200. Assumed annual return, 8%. At this rate, how long would it take to reach $1,000? By consistently investing just $200 every single month and earning an 8% average annual return, you would cross the $1 million threshold in approximately 40 years. Let that sink in. Someone who starts this at 25 could be a millionaire by 65, right at retirement age, all from an investment smaller than most monthly car payments. Now you might be thinking, but the stock market is risky, it's basically gambling. And you're not wrong to feel that way. In the short term, the market is incredibly volatile. But the key here is the long-term perspective. While past performance is no guarantee of future results, the S&P 500 has historically delivered positive returns over most 20-year rolling periods. The longer you stay invested, the more those scary short-term drops smooth out into a steady, upward climb. This path isn't about timing the market, it's about time in the market. You're betting on the long-term growth of the entire American economy. The biggest advantage here is the potential for high returns and how easy it is to get started. You can open a brokerage account and buy an index fund ETF for the price of a single share. The barrier to entry has never been lower. The downside, of course, is the emotional roller coaster. You have to be willing to watch your portfolio drop during market downturns and have the discipline not to panic sell. You have to trust the process and keep investing your $200 month in and month out, whether the market is up or down. If you have a long time horizon and the stomach for some volatility, this is, mathematically, your most efficient path to $1 million. Path number 2, the steady cruiser, bonds and balanced portfolios. If the stock market is a high-speed roller coaster, our second path is more like a steady, comfortable cruise. It's less about thrilling acceleration and more about a smooth, predictable journey. We're talking about investing in bonds or a balanced portfolio of stocks and bonds. So, what's a bond? When you buy a stock, you're buying a piece of a company. When you buy a bond, you're lending money to a company or a government. In return, they promise to pay you interest and give your original investment back at the end of a set term. Because of this, bonds are generally seen as much safer and less volatile than stocks. However, a portfolio of 100% bonds will grow very slowly. For someone looking to turn $200 a month into $1 million, a more practical, safer approach is a balanced portfolio. This is a mix of stocks and bonds. A classic example is a 60-40 portfolio, meaning 60% of your money is in stocks, like an S&P 500 index fund, and 40% is in bonds, through a bond fund. The idea is simple. You still get a good chunk of the growth from stocks, but the bond portion helps to reduce the overall risk and smooth out the ride. When stocks are down, bonds often hold their value or even go up, which helps protect your portfolio from severe losses. Now for the simulation. A balanced portfolio will naturally have a lower average return than 100% stocks. Historically, a 60-40 portfolio has delivered returns around 7 to 8%. But to keep our comparison fair and conservative, let's model this path using a 6.5% average annual return. The simulation: monthly investment, $200. Assumed annual return, 6.5%. So, how does this steadier approach affect our timeline? At this rate, investing $200 a month would take you approximately 45 years to reach the $1 million mark. As you can see, the trade-off for a smoother ride is a longer journey. It takes about 5 extra years compared to the all-stock approach. This might seem like a long time, but for many investors, it's a worthwhile price to pay for peace of mind. This path is perfect for someone who is more risk-averse. If the thought of seeing your portfolio drop 20% in a year makes you queasy, then a balanced approach could be your key to staying invested for the long haul. The best investment plan is the one you can actually stick with. If a smoother journey helps you sleep at night and prevents you from making emotional decisions, then this is an incredibly powerful path. The downside is purely mathematical. You're leaving some potential growth on the table. But don't discount the psychological advantage. This path acknowledges that the biggest risk for many investors isn't market volatility, but their own reaction to it. Path number 3, the hands-on builder, real estate. Our third path is one that people often see as the ultimate wealth-building tool. It's tangible, you can see it and touch it, and it feels more real than numbers on a screen. We are talking about real estate. The idea of becoming a real estate millionaire often brings up images of flipping houses or owning a dozen rental properties. But how does someone on a $200 a month budget even get in the game? It's not like you can buy a house for $200. This is where the path demands a totally different strategy: saving and leveraging. Unlike stocks, you can't just buy $200 worth of property each month, unless you're using a REIT, which acts a lot like a stock. For the traditional path of owning physical real estate, your $200 a month is first and foremost a savings plan. You are methodically putting that money aside, likely in a high-yield savings account, with one goal: saving enough for a down payment. Let's do the math. Saving $200 a month is $2,400 a year. For a 20% down payment on a modest $150,000 starter property, you'd need $30,000. It would take you over 12 years just to save that up. This seems incredibly slow, and it is. It's the biggest hurdle for this path. However, once you get that first property, the game changes. You can now use leverage, borrowing money to control a much larger asset. You put down $30,000 to control a $150,000 asset. Now your wealth can grow in 4 ways at once. 1. Appreciation. The property's value goes up. Historically, U.S. housing has appreciated at an average of 3% to 5% annually. 2. Loan paydown. Your tenant's rent payment pays off your mortgage, building your equity every month. 3. Cash flow. If your rent covers all your expenses, the extra is positive cash flow. 4. Tax benefits. Real estate offers significant tax deductions. So let's run a simulation, though it's a bit more complex. Let's assume it takes 10 years to save the down payment. Then you buy a property. Historically, residential real estate has seen an average annual appreciation of around 4 to 5%. The simulation: monthly savings, $200 for a down payment. Assumed annual appreciation, 5%. Because of the huge initial savings period and the lower base appreciation rate compared to stocks, reaching a net worth of $1 million this way would be incredibly slow if you just buy one property and wait. To speed things up, you have to run it like a business, using equity from your first property to buy a second, and so on. If we just use simple appreciation, it would take well over 50 years to reach $1 million net worth. The true power of real estate is in leverage and active management, but that also makes it the most demanding path. It's not a set-it-and-forget-it strategy. You are a landlord. You have to deal with tenants, toilets, and taxes. It requires a significant amount of your time and effort. This path is for the entrepreneur, not the passive investor. While it's a proven way to build wealth, it's arguably the most difficult and slowest path to get started on this specific budget. Path number 4. The slow and namp, steady tortoise, high-yield savings. This brings us to our fourth and final path, the one that is absolutely, positively, the safest route you can take. This is the path of the tortoise, slow, steady, and guaranteed not to lose a single penny of your starting investment. We're talking about putting your $200 a month into a high-yield savings account or a certificate of deposit, CD. A high-yield savings account is just what it sounds like, a savings account, usually at an online bank, that pays a much higher interest rate than the sad 0.01% you might get at a big traditional bank. As of late 2025, you can find accounts offering rates around 4% or even a bit higher. These accounts are FDIC insured, meaning your money is protected by the government up to $250,000. It is, for all practical purposes, risk-free. CDs are similar. You agree to lock your money away for a set term, and in exchange, the bank gives you a fixed interest rate, So this path is all about keeping your money safe. You will never lose what you put in. But what about our goal of reaching $1 million? Let's run the simulation with a generous and frankly optimistic long-term average return of 4%. The simulation: monthly investment, $200, assumed annual return, 4%. With this strategy, how long would it take to hit the $1 million mark? The answer is sobering. At a 4% return, it would take you approximately 58 years to reach $1 million. And here's the most critical part. This doesn't even account for inflation. The long-term average rate of inflation is around 2 to 3%. If your money is only earning 4%, your real return, the actual growth of your purchasing power, is only 1 to 2%. So while your account might say $1 million after nearly 6 decades, that million will buy you significantly less than it does today. This is why experts say that just saving your money in cash is actually a losing game over the long term. You're not losing money in name, but you are losing purchasing power to inflation every single year. So who is this path for? This is not a wealth-building path. It's a wealth-preserving path. A high-yield savings account is an excellent place for your emergency fund or for saving for a short-term goal, like that real estate down payment we just talked about. But as a primary strategy to grow $200 a month into $1 million, it's simply not the right tool for the job. It's like trying to win a Formula One race in a golf cart. It's safe, it's reliable, but it was never designed for speed. So, there you have it. 4 paths, 4 different timelines. Path number 1, the stock market speedster, can get you to $1 million in about 40 years with index funds. It's the fastest, but it requires the stomach to handle the volatility. Path number 2, the steady cruiser, uses a balanced portfolio to smooth out the ride, extending the journey to about 45 years. It's a trade of speed for peace of mind. Path number 3, the hands-on builder, uses real estate. It's powerful, but it's an active business that requires a long initial savings period, pushing the timeline to well over 50 years without aggressive tactics. And finally, path number 4, the slow and amp, steady tortoise, uses safe savings accounts. But it's a path of preservation, not growth, taking a staggering 58 years or more, all while your money's value gets eaten by inflation. What's the biggest takeaway here? It's that turning $200 a month into $1 million is not a fantasy. It is a mathematical certainty, provided you do 2 things: choose a path with a return that beats inflation, and most importantly, stay on that path consistently for decades. The real enemy isn't a low income, it's time wasted. It's the years spent thinking you don't have enough to start. The truth is, $200 is more than enough as long as you put it to work and let the magic of compound interest do its job. The best time to start was yesterday. The second best time is right now. So, I have a question for you. Which of these 4 paths are you on? Or which one are you most inspired to start? Let me know in the comments below. I read every single one, and I'd love to hear your story. And if you got value from this video and want to know exactly how to open an account and buy your first index fund, make sure you subscribe and check out this video right here where I walk you through it, step by step. Thanks for watching, and I'll see you in the next one.